will have two frames of income statement, as you can see on the screen. The first is the single-step method, and the second is the multiple-step income statements. In each frame, there will be some differences. And now we will come to the purpose and uses. The purpose of income statement is to provide information about the revenues, expenses, gains, and losses associated with company operations during a specific period. Uses for investors, they need to take care profitability and value. For lenders, is a creditworthiness, and for managers, useful for decision making. Yes. In single-step income statements, we will see that all revenues and gains minus all expenses and losses will get the pre-tax income. And then we continue to minus from pre-tax income to income tax expense, and then the results will be the net income. But in multiple step income statements, there could be a little bit more complicated. We will take sales minus cost of goods sold to become gross profit. And then we continue to minus operating expenses to come to operating income. And then to minus non-operating of gains and losses to become pre-tax income. And after we minus the income tax expense from pre-tax income, we will come to net income. The income statements reports the results of an entity's operations over a period of time, such as the year. The income equation income will be revenues add gains minus expenses and minus losses. The following are the elements of the income statements. Revenues or inflows or other enhancements of assets or settlements of liabilities or both, from delivering or producing goods, providing services or other activities that qualify as ongoing measure or essential operations. Gains are increases in equity or net assets other than from revenues or investments by owners. Expenses are outflows or other usage of assets or incurrences of liabilities or both, from delivering or producing goods, providing services or other activities that qualify as ongoing measure or essential operations. Losses are decreases in equity or net assets other than from expenses or distributions to owners. All transactions reflecting the net change in equity during the period are included in income, except transactions with owners, prior period adjustments, such as error correction or change in accounting principle, items reported initially in other comprehensive income, and transferred to and from appropriated retained earnings. Cost of goods sold and cost of goods manufactured. Cost of goods sold is an expense account reported on the income statement. For a retailer, cost of goods sold represents the cost of the items being sold to customers and is calculated based on the changes of inventory. Beginning inventory, $10,000 plus net purchases, $14,000 plus freight in 1,000 goods available for sale, $24,000 and minus ending inventory, $5,000. Then we will get the cost of goods sold, $20,000. For a manufacturer, cost of goods sold represents the cost of items that were produced or manufactured by the firm and are being sold to customers. Manufacturers must calculate the cost of goods manufactured in order to calculate the cost of goods sold. The cost of goods manufactured is the cost of goods complemented during the current year. It represents the cost of goods transferred out of work in progress inventory to finished goods inventory. Manufacturers calculate cost of goods sold as follows. Beginning direct material inventory. Add purchases during the period. And minus ending direct materials inventory. Then we will come to direct materials used in production. Then we'll look at direct labor cost and manufacturing overhead cost to become total manufacturing cost. And then we'll go at the beginning work in progress inventory and minus the ending work in progress inventory to become the cost of goods manufactured. And then we'll go at the beginning finished goods inventory and minus ending finished goods inventory to get the cost of goods sold. Cost of goods sold is recognized at the term of the goods are sold, which follows the matching principle. Gross profit is a net difference between sales revenue and the cost of goods sold. Gross profit margin as a percentage of sales is calculated as follows. Gross profit margin will be the gross profit divide sales. And then please pay your attention to the screen, and then we'll consider the table here. First, we got the example on the left of your screen. We have some figures about the inventory and some more other information here. On the first day of January, raw material will be $65,000. Work in progress, WIP, will be $10,000 and finished goods, $30,000. And then we also have some figures on the December the 31st day. December 31, raw materials, the $58,000, work in progress, $120,000, and finished goods, $26,000. We also have some other information about the purchase of raw materials, the direct labor, the factory rent, factory utilities, advertising expense, and administrative salaries. Now, what should we do? We need to calculate the cost of goods sold, but before coming to the calculation of cost of goods sold, we need to go through some steps. The first steps, we need to find the direct materials used in the production. Here, we can see the inventories on the table. We will start from the beginning raw materials, and then we add purchases during the period, and we will get the materials available. Then we last ending raw materials to become the materials used in production. The second step, to find the total manufacturing cost. Many materials used in production, we will take it from the manufacturers. We calculated in the first step. And then we will add the direct labor and manufacturing overhead. Manufacturing overhead will conclude factoring rent and factoring utilities. And then we will get the total manufacturing overheads. And we take materials used in production, add direct labor, add total manufacturing overhead to get the total manufacturing cost. To the third step, we will calculate the cost of goods manufactured. Total manufacturing cost will be taken from the second step. It is $652,000, and we will add the beginning WIP inventory and last, the ending work in progress inventory to get the cost of goods manufactured. Yes. And after getting the cost of goods manufactured, we then will calculate the cost of goods sold. We should take the cost of goods manufactured at beginning finished goods inventory and less ending finished goods inventory to become the cost of goods sold. About other expenses, general and administrative expenses are incurred for the benefit of the enterprise as a whole and are not related wholly to a specific function, selling or manufacturing. They include accounting, legal, and other fees for professional services, officers' salaries, insurance, wages of office staff, miscellaneous supplies, and other occupancy costs. Selling expenses are those incurred in selling or marketing. Examples include sales representatives' salaries, commissions, and travel expenses, sales department salaries and expenses, including rent, advertising, and credit and collection costs. Shipping costs are also often classified as selling expenses. Interest expense is recognized based on the passage of time. In the case of bonds, notes, and finance and leases, the effective interest method is used. And then we will understand more about discontinued operations. When an entity reports a discontinued operation, it must be represented in a separate section between income from continuing operations and net income. Because these items are reported after the presentation of income taxes, they must be shown net of tax. The term continuing operations is used only when a discontinued operation is reported. Discontinued operations, if reported, may have gain or loss from operations of the component that has been disposed of or is classified as a held for sale from the first day of reporting period until the date of disposal, or the end of reporting period if it is classified as a held for sale. Gain or loss on the disposal of this component. Yeah, and on the right side of your screen, there could be net of sale. Then we minus cost of goods sold to become the gross profit. And then we will minus selling expenses and administrative expenses to get the income from the operations. And then we add other revenues and gains, or sometimes we have to minus other expenses and losses to become income before taxes. And then we minus the income taxes to get the income from continuing operations. About discontinued operation, we will start from the income from continuing operations. And then we can see that we have some gain from operation of component, including loss on disposals, $4,000, and income taxes here will be minused. And then we get gain from discontinued operations for $6,000. $6,000 will be added with the income from continuing operations to get the net income here. Yeah. But everything has its own limitations. Yeah, in this situation, we can see that manipulation through assumptions and estimates. In income statement, there will be depreciation, method, useful life, salvage value. Yeah, they are estimates. And bad debts, evaluation of receivable rates, warranties, likelihood and amount of future claims. Income smoothing is also an issue here. The benefit is better able to project future performance, but that the detriment will disguise risk and auditor's performance. Classification shifting, operating and non-operating.